Well, emerging markets tend to be highly correlated. Looking beyond these, there exists a range of markets with significant growth benefits. And once one considers their geographic and demographic diversification, they make a compelling investment case. These are called horizon markets. And tonight we'll be delving into the investment case for these. We welcome our guest from Cape Town, Kamal. Thanks so much for joining us. So Kamal, you've of course got a mandate to look into new growth markets for Investec. Tell us why Investec is focusing specifically now on horizon markets.
Well, thank you for having me on the show. I should add that the horizon markets offering is one of several emerging markets capabilities that Investec Asset Management has to offer. Our focus on the horizon markets is driven by a fundamental belief that asset allocators in general, whether implicitly or explicitly, have overweighted their emerging markets allocations to what we call the large emerging markets. Now, you've of course described the BRICS. We define the large emerging markets as markets greater than a 5% weight in the MSCI Emerging Markets Index. And candidly, you could use the MSCI Emerging Markets Index, the S&P, the Russell, the FTSE, it doesn't matter. These 7 markets, there are 7 of them, the BRIC countries, South Africa, South Korea, and Taiwan, make up approximately 80% of the index. So as allocations are made to the emerging markets, these 7 countries receive a disproportionate amount of the investment capital, with the remaining 14 countries in the index that we call the smaller emerging markets, less than 5% weights each, receiving very little dedicated investment capital. So when you take these 14 smaller markets and you combine them with the so-called frontier markets, you end up with a much broader universe with a greater investment opportunity set that is currently, we believe, being very poorly captured in a consistent, systematic fashion.
Mm-hmm. So let's break that down into the markets, because of course it's not just the BRICS as we call them. It includes Korea, Taiwan making up a large portion of that emerging markets index, and then of course you break it down to the smaller horizon markets as shows on the graphs.
And I mean, the old adage here is very important. If a market is neglected, chances are there's fantastic valuation opportunities available in the market such as that.
And that's of course the purpose of today's show.
And absolutely. But I mean, it's an adage that one has to remember right across all asset classes and right across absolutely all markets. And we're talking about something that, you know, with living in an emerging market, often people kind of neglect the fact that there's a whole range of markets beyond South Africa. Look just at your screen. Let's just show you what emerging markets actually look like at this stage of the game. And you could see kind of the large emerging market block. And all of those countries, quite frankly, you live in one of those, and because we're recording in South Africa today, you can see some of the other ones there. But if you once you start talking about horizon markets, have a look at what those look like. You see the small emerging markets over there, and you see 14 countries that make up that list over there, and Kamal was talking about those just now. And then frontier markets, there's 25 frontier markets. Now we can't fit them all onto the screen over there. And you would have known about some of those, but you potentially didn't know that you could actually invest in some of those. Just to show you what some of those attributes look like. What are, you know, in horizon markets, how many countries? Well, 40 countries. Number of stocks, 994. Market cap there at 3.1 trillion, making it sizable, quite frankly. And the daily value traded there at $4.8 billion. I mean, Roland, would you agree with that? I mean, $4.8 billion worth of trade per day. I mean, that's liquid. I mean, you can actually do something with that in portfolio construction.
Yeah, it depends on your fund size and who your client base is, but absolutely, if you're starting a new strategy in that area, it must be literally like a kid in a sweet shop, because there's so much unexplored territory there. I think we're calling them smaller emerging markets, but they're certainly not small. So they neglected in many ways. I guess when you get to the frontier markets, you're getting to the more illiquid kind of situation. Is that correct, Kamal?
I think that's a very important distinction to make, Roland. I mean, we, for example, have identified a universe of, as you just said, 994 stocks that would meet our investability criteria. And of this universe, roughly 2/3 has a market capitalization greater than 5 billion. In other words, this is not a small cap proposition. This is a substantive market opportunity. A lot of the stocks in our universe are either overlooked, under-researched, and indeed quite a few have no brokerage coverage.
And of course, we see the graph up on the screen there. 65% of the horizon markets have a market capitalization of above $5 billion. But there are some really small ones, and of course are making up a very small percentage.
Yeah, I mean, just put that back into South African rand terms. You know, we're talking about something 35, 40 billion rand over here, you know, back in South Africa. That's a sizable corporation in South Africa. You know, that's definitely not a small type of business. The question though is, how do you utilize some of this stuff from a portfolio construction perspective? Because I think, you know, once you're in Horizon Markets, what is the ideal amount of capital that you'll throw at an idea like this? I mean, Kamal, maybe this is a question for you, and I'd like to hear Roland's opinion as far as this is concerned as well. And we're going to be looking at some more efficient frontiers a little bit later on. But just quickly, just off the bat of that, what do you think should be the correct allocation towards Horizon Markets in a diversified portfolio set?
Let me preface my answer by pointing out, and I believe you have a slide to this effect, that the impact of over-concentration within the large emerging markets over time has produced significant volatility in emerging markets allocations. Indeed, there's a slide that will show you that on average, every 16 months or so, there's a drawdown of greater than 10%, which suggests significant volatility in any one given large emerging market allocation. The Horizon Markets have the benefit of providing a certain degree of diversification and with that volatility dampening. So if, for example, a portfolio had, say, a 5% dedicated weight to emerging markets equity, our argument is not that you should not have large emerging markets exposure. Indeed, we would argue that you should very much have large emerging markets exposure. There's every reason you would want to do that. This is a complementary solution. So if you have a 5% weight to emerging markets and you assume that of that 5% weight, anywhere from 50 to 75% is dedicated to large emerging markets, we would argue that anywhere from 50 to 25% should be dedicated to the Horizon Markets as a standalone investment.
Yeah, if we look at that graph of the drawdowns, just to take the viewers through this, in effect, this is the depth and the duration of loss that you can experience by having your money in the S&P 500 or in the emerging markets. Now, these are obviously all the emerging markets, and probably the reason why you're seeing these deep drawdowns is that we mentioned this earlier on briefly, is the correlation within or amongst the emerging markets, which is dominated by these BRIC countries.
And of course, let's not forget those two others, because we keep, you know, I don't know if BRICS has any relevance anymore.
Well, most people refer to them in that sense, but you're absolutely right. There are two others there, and South Africa. So the volatility and the concentration risk is what contributes to this kind of severe or higher losses during bear markets. Now, what Kamal is trying... Well,
that's right, Roland. I mean, I think, I beg your pardon for interrupting, I think it's important your viewers understand that as a fund manager, for example, sells Samsung, that fund manager is equally likely to sell Taiwan Semiconductor, Reliance Industries, Gazprom, APSA, Bradesco. So you have the creation of correlation volatility, which produces this sort of outcome.
Correct.
And of course, you know, we see that on a daily basis, just reiterating that point. A sell-off in risk assets, you see that emerging market coming under pressure, and very rarely do you see, outperformance from one of the individual emerging markets. But of course, that's perhaps where Horizon Markets might come in. What type of divergence do we see, Kamal, when it comes to performance, perhaps, not so much on a daily basis, of course, but on a more, tangible basis? What type of divergence do we see between Horizon Markets and the larger emerging markets?
Well, there is a risk-return trade-off slide that essentially positions the Horizon Markets relative to the MSCI emerging markets, the MSCI BRICS, and the frontier markets. And you will see that the Horizon Markets as a universe, as a dedicated investment, fall in the upper left quadrant, so to speak, of an efficient frontier curve, which is highly desirable. So in other words, you have the added benefit of lowering a portfolio allocation's volatility while not necessarily finding yourself sacrificing returns. This is an extremely important point to make. In fact, our modeling, our research suggests that in general, the Horizon Markets have outperformed the MSCI Emerging Markets Index while delivering lower volatility.
Okay, so let's just quickly, I just want to bring the viewers into the equation, so to speak. When we kind of talk about the maths behind the markets. Just to have a look quickly at the graph again, and Kamal spoke to you about this graph. We're talking about a risk-return payoff over here, and we're looking at data captured between January 2002 and December 2011. On the x-axis is what's called standard deviation, or the risk, or the volatility of being in various asset classes. And on the y-axis is the total return per annum that you would be picking up from these markets. So you can see this is what Kamal was talking about just now. Horizon markets during this period has actually been quite a favorable play. The risk that you've assumed relative to the return that you've actually picked up for this has actually been very, very desirable. Relative to everything else, if you were an MSCI brick, well, quite frankly, the risk that you would have picked up relative to the return is kind of commensurable between the two, but certainly not as good as Horizon markets. I mean, Roland, here's a question for you. Certainly, the one issue for me at play at this stage is the fact that you've sat with an under-researched asset class in Horizon markets. And as it becomes more and more research, as returns continue to prop up, won't it kind of drift down kind of the XY axis so that it, on the efficient frontier, it just comes and kind of joins the rest of the guys on the continuum?
Yeah, I think the concentration, the correlation is one issue, but and the under-researchedness is another issue. But if we have 20% of emerging markets sitting in these so-called smaller markets, broadening your exposure to that kind of asset class is what gives you the risk-return diversification benefit. So you've got two benefits here. You can actually increase your allocation to smaller and frontier and horizon kind of markets away from the BRIC countries. But you can also, within there, on a stock picking basis, try and add value. So you're getting an opportunity set that's greater as well as a risk benefit.